Oil isn't the new gold. Gold is the new gold. It's the old gold, and it's the always gold. And that's where you should be focusing. And it's the monetary metal in a monetary-based crisis, which is the fiat and debt debasement. So I just want to reduce it simply. You're going to win, but you could have a little bit of volatility and chop in the process if we go deflationary for a spell. But longer term, the further that happens, the harder you'll pump in the opposite direction. So if you're an investor and you're on the long term, you're in the right seat. Stay strapped in.
In the midst of a severe monetary crisis driven by endless fiat currency creation and unprecedented debt debasement, investors are desperately searching for a safe haven. While some speculators claim that oil is the new standard, the macroeconomic reality is much simpler. Gold is the new gold. It remains the undisputed, original, and eternal monetary metal. During periods of extreme economic instability, focusing your portfolio on this tangible asset is the most reliable strategy for long-term wealth preservation. FrancisHunt, a highly respected macroeconomic analyst, emphasizes that while the journey may experience short-term deflationary volatility and choppy price action, the long-term destination is completely secure. This temporary downward pressure only serves to coil the spring tighter. Ultimately, the deeper the short-term deflationary shock, the more explosive the eventual upward trajectory will be as fiat currency debasement accelerates. If you are positioned in physical gold with a long-term horizon, you are in exactly the right seat. Just stay strapped in and let the macroeconomic cycle play out. Now, we present the clips from FrancisHunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
You have sold off, but I want to just say our position technically is that there's a range definition by the blow-off high into there. That's 5,600. And then there's the overreaction to the downside, which is 4,400. So we are now in this range. We were grinding higher. It was all quite a grind. You weren't ever running a risk of breaking out and running from any of this. And then you had this little rising wedge here, over there. It was always looking like you would have a sell-off. And then you hung 5 for a couple of days, very low vol on the 5K, which is the 50% of the high here. So there's a beautiful symmetry to this. 5,600, 4,400, and 5,000. So you've just fallen below the 5,000 level, which is the 50% fib. I can throw that up and you can see it, but you can take it also from me that that's measured perfectly to the 2. There you go. You can see the black line is the 50%. So we've just surrendered that. So as long as, for me, as long as we are in this range as defined by this, we are shaking out the volatility of what was quite a volatile event. Don't forget, you came in, you're about 4,270 after the last, and you just ran straight up to 5,600, quite, near straight line. That's a lot, 4,270 to 5,600. Even at 4,300, if we call it, to 5,600, that's $1,300 on gold you made in the space of, before the beginning of the year to before we'd even finished February. It was just January and just January really, because it was at the end of January that this correction occurred. So that was quite violent. This was a high volatility period. You don't need me to tell you, but I'll say it anyway. So I think you need a down leg, and I'm quite comfortable with it coming all the way back down here. I start to get worried. It's no longer in the range, obviously, if it trades through the 4,400. So that would be an alert place for me. Okay, we're not setting up a continuation pattern in range as per the definition of the blow-off high and the subsequent low. I don't think we're going to trade through the 4,400. So my base case is you're going down now, but you're going to stay within this range. However, I'll let the market tell me. Why don't I think that? Because the rally on gold, not on silver, but gold is the king, and this is the one we should be watching, the king anti-fiat. This took you through the 78.6 fib of this range. So again, if I put that fib back on, you will see that the rally bounce took you through the 78.6 to a high. You're probably at about 80%. That's not typical of downside continuation. that you sell off and you retrace 80% of the move. Not typical. So it tells me that we're winding up inside the range of the 4.4 and the 5.6. That means it's going to be a boring, dull market for a bit, little bit down, little bit up. We manufactured a trade on the gold Aussie over here. This is the gold dollar, but we manufactured a trade there that got us out on the gap, and then it was the war. So it was very much a buy on the rumor, sell on the fact. So again, insiders everywhere on this, and now you're correcting downside. So it's down, 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 down. The only thing that would be a major escalation and see the 4.4 relent for me on gold would be if we have in short form this credit, this bottom end of the credit pile, private credit, get disorderly and lead into other credit markets. I can see that happening, but I can see that happening medium long term. If that accelerates now in terms of where we are, you get a bit of deflation, and you get the people that own private credit that also own other good assets becoming forced sellers of those good assets because they don't want to mark to market the losses on the bad assets, and you can then get a little bit of a deflationary event, and that can see gold possibly get sold off on liquidation. Right now, these are not fat candles, Danny. These were fat candles. They were showing you the volatility. That shows you a bit. These are thinning out. So the whole energy is dissipating. And going to sleep and calming down is actually what you want inside the range. That'll set up continuation in the end. So my bias is we remain in the range, and we're likely going to set up a continuation pattern. And I can point out other type examples that are very similar in terms of what we predicted and how it panned out. You may remember Liberty Day with Donald J. Trump playing 5D chess. Stick to the plan, you all. Yeah, you might remember that. You had a major blow-off move that led to that high, and then you had that big correction. And then it was a chop and a churn for a while through the British summer, because I was in London at the time, down, down, down. Second impulse finally closed there, and then a short third. And then only as the traders got back to their desk, end of August, starting the summer over, you could see exactly. And I highlighted this because in 2008, I called 2nd September is the day. That was when it was the Monday when all the traders were back in the day, that gold will break out and take out 1,000. This would be the first time and the last time it would trade 3 digits. And that exactly happened. So the traders being back in the desk meant that we had a bit of a protracted second impulse. So that is kind of like that. A bit of an M head. There was your third. That was your break. And then you had one of the cleanest low volatility runs come. So people shouldn't bemoan a quiet spell. Go spend some time with your family, get off the computer, the screens. There was your continuation. This move, I mean, I was just looking at it again. We can put it on Play Me. It's worth seeing. You know, right up until the next high. It was absolutely beautiful. Let me wipe my face a bit there, and let's just go and do that. It's just worth seeing the replay. Start new, start from there. There you were. There's where we were. Trading down. Go ahead and play. Watch how it just transpired. And such low volatility, but consistently up. Here you come. Now you're taking out this high. That's a triggering event. Look at the smooth, clean, green candles. Very little downside. Steady goes, steady goes, steady goes in a beautiful channel to the upside. A little bit of a pause there, very low volatility. Keep suspecting continuation, a break, a return move, more upside, more upside. So it goes, so it goes. I mean, that's the gift that comes when you're patient during a volatility squeeze and a continuation pattern. So my suspicion is I'm going to suspect continuation. We are continuation traders for breakouts. And so you can see how beautifully it went. Then you got your first major high volatility setback. And I'll pause it there. But look at that run. I mean, that's a run to die for there. You know, you started at 3,300. You woke up and you're at nearly 4.4. It's $1,100 with very little red days. And even the red days weren't particularly big amongst them.
Gold is currently experiencing a necessary period of healthy consolidation after an explosive, high-volatility run to the $5,600 level. By defining the trading range between the $4,400 floor and $5,600 peak, technical indicators confirm the market is effectively shaking out excess speculative energy. Although the price recently dipped below the crucial $5,000 midpoint, this structural pullback establishes a highly bullish setup. The initial relief bounce aggressively retraced nearly 80% of the downward move, completely shattering standard bearish continuation patterns. As daily trading ranges narrow and overall volatility rapidly dissipates, this dull market action is intentionally building immense foundational support. Historically, these exact quiet periods of low volatility churn consistently precede massive, uninterrupted breakout rallies. Unless a catastrophic systemic credit collapse forces sudden widespread asset liquidations, the primary technical bias remains fiercely locked on a powerful upside continuation. Patient traders recognize this consolidation as the necessary precursor to the next major parabolic surge. Let's get back to the interview.
The AI bubble will have a nominal level reset, not just in gold ounces, in nominal terms, in dollars. We will have a key sell-off. And I think some of that crazy credit has been directed there. I think some Middle Eastern money was directed in there. I think some of this private credit story has gone in there. And as I mentioned, when you start a debt collapse, it always starts on the fringes with the dodgiest quality. But the problem is the fire keeps burning and comes through the walls, the paper walls, to even the more pristine. I've already heard that non-subprime, in other words, good quality standard lending, is having higher default rates. People that were considered good quality credit ratings are having higher defaults on cards, homes, car financing, and everything. So the debt-based crisis, and we are yet to see real material rate rises. They're working their way through on the 10 years, we've said, on Aussie, on all the countries. We run the route on the Japanese in 2020 and 2021, and we're calling for higher rates. They've all transpired. Now we've got this crisis. This is all further. Not long ago, everyone was telling me we're wrong on our higher rates. Powell's going to be kicked out by Trump and some dove is going to be put in. And I said, well, you can do whatever you like on the puppets and the teleprompter readers, but the debt has to devalue. And that means rates go higher. Well, no one's saying rate cuts anymore. No one's saying rate cuts anymore. The short is debt because it is the primary bubble. And the beneficiary as a reserve asset dying, long run, is gold. I do point out that in a deflationary flash of credit collapse and a liquidity surge, gold can be sold off, and silver even more so. But the net effect later, it's the typical look one way, end up running the other way. So for me, both gold and silver will outperform oil as an asset category if you're looking anything medium and long term. So everyone getting super excited about oil. With the amount of debt we have, some saying $300 and all of that. The point of the matter is, the key point I made is that we're far more indebted. We won't run Volcker rates because we'll collapse well before. The system is 5 times more sensitive, 10 times, 100 times, because the degree of debt is far more. Derivatives will collapse, everything, if we start going meaningfully much higher. We can't do deep in the teens like Volcker. And at the same logic applies if oil is driving the inflation. It can't really go 300 and 400. It might spike there, but long before it gets there, the contagion will commence, and it'll very quickly be forced to correct because you'll just go into a complete deflationary environment. So oil is not gold. If it goes too far beyond as a consumable without substitutes, you lose economic activity, a massive amount of it, and you get a massive deflationary force that quickly rectifies it. Whilst gold, it's got the sky's the limit because how much debt have they created that is unbacked, that is going to collapse in? Well, that's all that money is going to move into gold because there is no other reserve asset. Property is going to go down. It's too financially engineered. Stock market's going to go down. It's too excessively bubbled up on that same debt. In fact, every asset class is a failure based on excessive access to debt, fiat, and financing. Only gold is unlevered and doesn't have that. So in the end, gold wins, and the silver and platinum, but gold is the king and it'll move first next. Don't be shaken out. Try buy in major volume now. Silver. I would like, if Eric's still around, I'd love to hear his opinion. I don't want to keep him up too late. I know it's late there, but try buy $10 million of silver right now, even at these low prices. See what they tell you in terms of delivery, how you'll have to send the money, how they'll have to wait for a while, how they'll say, listen, we reserve the right to requote you if there's any major moves. They will have to search and squander. The supply is thinner than ever. The crisis, the Iran and Hormuz crisis, took the pressure off a real squeeze on silver. That was happening. They cheated outright on the final day of the options with their fake stories. And it won't be long before we'll be returning to these narratives. That supply behind it is still very, very low. If you can get it, secure it, regardless of what cash price does short term. Good luck trying to get it for that price. You'll have to send all the money in advance, and they'll say, we'll only give you a fixed strike once we've accumulated the bulk of it and we've got locks on all the supplies. So that's my take. Oil isn't the new gold. Gold is the new gold. It's the old gold, and it's the always gold. And that's where you should be focusing. And it's the monetary metal in a monetary-based crisis, which is the fiat and debt debasement. So I just want to reduce it simply. You're going to win, but you could have a little bit of volatility and chop in the process if we go deflationary for a spell. But longer term, the further that happens, the harder you'll pump in the opposite direction. So if you're an investor and you're on the long term, you're in the right seat. Stay strapped in.
The global economy is facing an inevitable debt collapse that is actively spreading from subprime borrowers directly into pristine, high-quality credit markets. As the artificial intelligence bubble resets and widespread defaults rise, it is mathematically clear that the heavily leveraged financial system cannot survive historically high interest rates without triggering a catastrophic derivative contagion. While some speculators mistakenly view oil as the ultimate hedge, extreme energy prices will only destroy economic activity and force a massive deflationary correction. Gold remains the undisputed king because it is completely unlevered and carries zero counterparty risk, whereas traditional asset classes like real estate and equities are artificially inflated by excessive fiat financing. Furthermore, the physical silver market is currently experiencing unprecedented structural shortages. Massive institutional orders are now facing severe delivery delays and immediate price requotes due to drained global supplies. Although the market may endure temporary deflationary volatility, the underlying macroeconomic reality guarantees that tangible monetary metals will absolutely skyrocket as the fiat debt system unwinds. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.